Zulte uses the information from preliminary prospectus for Tagon's initial offering. The company intends to issue 1 million new shares. In his conversation with investment bankers for the deal, he concludes the offering price will be between $7 and $12. The current capital structure of Tagon consists of 2.4 million 5-year non-callable bond issue and 1 million common shares. The following table includes other information that Zulte has gathered. Currently outstanding bond, risk-free rate of interest, estimated equity risk premium, tax rate. Question is, what is the marginal cost of capital for Tagon based on average asset beta of 2.27 for the industry and assuming that new stock can be issued at $8? Marginal cost of capital, MCC, means the cost of last capital raised by the company. MCC can be calculated by weight of debt multiplied by cost of debt multiplied by 1 minus tax rate plus weight of equity multiplied by cost of equity. And there is no preferred stock in this question. So we need to calculate each of component to calculate MCC. Let's calculate weight of debt first. Weight of debt is the market value of debt divided by market value of total capital, which is composed of debt and equity. The question said market value of bond is 2.156 million. And market value of equity can be calculated by number of equity, in this question 1 million new share and 1 million outstanding. So 2 million multiplied by price of equity $8. So equity market value becomes 60 million and market value of total capital becomes 18.156 million. And weight of debt becomes 0.1187. Let's calculate weight of equity. Weight of equity is market value of equity divided by market value of total capitalization. Market value of equity is 60 million and total capitalization market value is 18.156 million. So weight of equity becomes 0.8813. Let's calculate cost of debt. Cost of debt is YTM. To calculate YTM, we have several information already provided. Face value 2.4 million and present value of 2.156 million. For 5 years, semi-annual payment, so payment frequency becomes 10, and coupon payment amount becomes 2.4 face value multiplied by period coupon payment rate 6.25%. Then coupon payment amount becomes $150,000. $0.15 million. So using the calculator, let's calculate interest of period. 2.4 face value, 2.156 present value, frequency 10, payment amount 0.15, then compute interest of period becomes 7.74548%. By multiplying by period, YTM becomes 15.5%, 0.155. Let's move on to calculate cost of equity. Cost of equity can be calculated by CAPM approach, which becomes rate of free rate multiplied by beta of stock multiplied by stock premium. The question said risk-free rate of interest is 0.0525, and we can calculate beta of stock because we know the asset beta is 2.27. So beta of stock can be calculated by beta of asset multiplied by 1 plus 1 minus tax multiplied by debt divided by equity. So beta of asset is 2.27. 1 plus 1 minus tax rate is 23%, 0.23 multiplied by debt market value is 2.156 and equity is 16. Then it becomes 2.27 multiplied by 1.1038. Then beta of stock becomes 2.5055. So let's plug in beta of stock into the formula to calculate cost of equity. Then it becomes 2.5055 multiplied by stock premium, it's 7%, 0.07. Then we can calculate cost of equity becomes 0.2279. So now we know the cost of equity and cost of debt, weight of debt, and weight of equity. So let's plug in to calculate MCC. Then weight of debt 0.1187 multiplied by cost of debt is 0.155 multiplied by 1 minus tax rate is 23%, 0.23 plus weight of equity 0.8813 multiplied by cost of equity 0.2279. Then it becomes 0.01417 plus 0.20084. Then marginal cost of capital becomes 0.215. Then it becomes 21.5%.